Yes, we will resume it what we left in the last class. So let's try this example to reiterate our understanding on considerations. Try this example. Liability of 100,000 is to be paid in 2 years. The discount rate is 6%. At what amount should the liability be recorded? So what must we do?
So first year will be
Now here they don't talk about any consideration. They just say that there's a
2 years.
liability. There's a liability to be settled in 2 years. So at what amount you should record the liability now? So
6% in 2 years, right? Discount factor everything.
correct. So how much is that? 100,000. So 100,000 into
6%.
1 over 1.06 to the power
2.
Can you count?
I can take like this one directly.
You can no. You have DCF table there?
Yeah.
If you have DCF table, yes.
That is 0.890.
0.89,
2 years 6%.
89,000 then.
Correct.
Yeah, that's correct. Okay. So let's try one more question here. Yeah. ABC acquired 300,000 of DEF 400,000 ordinary shares during the year ending 28 February 2015. DEF was purchased from its directors who will remain in the current roles. Was purchased from its directors who will remain in their current roles in the business. The purchase consideration comprised 250,000 in cash payable at acquisition, 80,200 payable 2 years after the acquisition, 100,000 payable in 2 years if profit exceeds 2 million. New shares in ABC at acquisition on 1-for-3 basis. The consideration payable in 2 years time after acquisition is a tough target. I think we did this
We
question.
did this question.
This same thing came in the previous example also, previous chapter.
Yes. Yeah.
So we don't need to redo this. At the beginning,
Activity 2 then.
but this is the new chapter. But I think this is the same question in the previous chapter also. Anyway, we will skip. You know.
Okay, yes, yes, okay, we done that.
So okay, let's.
Yes, we done.
Okay. Subtitle: Impairment testing.
Impairment
Testing. Any goodwill arising on a business combination should be tested for impairment annually. Irrespective of whether there are any specific indicators of impairment. Any impairment may be expressed. Any impairment may be expressed as an amount or as a percentage. Right, double entry. Now, let's say your impairment amount is 150,000. Now then, this is impairment on goodwill. Impairment on goodwill. Then what we do is this goodwill account we credit here to reduce that amount of impairment, and then we debit to group return.
From the return.
Yes. So here you write group return earning. Here you write goodwill. So the entries will be debit group return earnings, credit goodwill. You can say alternatively, when NCI is measured at fair value, the goodwill in the statement of financial position, includes goodwill attributable to the NCI. So what I am trying to say, if you remember, when we calculate the goodwill on consolidation, we also take the NCI fair value. So when we have the NCI fair value, the goodwill, this is how it comes now. We have purchase consideration, and then we have fair value of NCI. We take the total, and then we subtract the net asset of subsidiary, whatever it comes. So this answer is what you call
NCA.
goodwill. Now what I want to tell you, in arriving this answer, the NCI also contributed.
Yes.
Correct? No? So now when goodwill is suffering from impairment, we also need to give such a portion of penalizing NCI as well. It's not only to penalize the group, you have to penalize the NCI also. So in that case, let's say your goodwill impairment 150. Now 80% parent, 20%
NCA.
NCI. So what you do is you credit to goodwill 150.
Yes.
Debit 120 will be to group return earning. 120. Another debit to NCI 30.
NCA return in that value, NCA value. Okay.
Understood now?
Understood.
So now we already have our accounts, NCA already we have. Now after the impairment, we need to debit 30 here.
Correct.
Clear now?
Yes.
So this is what you need to do. Okay, shall we try this now?
Yes, yes, yes.
So you wrote the double entry?
Yes. But this one you didn't. The percentage.
But that is just I gave example. Entry is you debit group return earning, you debit NCI, and you credit the goodwill. Using the information in activity 1 above, assume that in the year ending 31st March 2016, the goodwill of W is impaired by 20%. First, you need to know how much is the goodwill from the activity 1. So this question, Singh company acquired Wing company. In the same chapter. No? You don't have?
21. No?
Can you check the investment is 80,000?
Yes.
Think company, Wing company.
Say 12,500. Return in 10,000.
Return earning of the subsidiary 10,000. Correct.
Right.
So how much is and the NCI is 12,000. What is the goodwill?
So
How much?
32,500.
32,500 is the goodwill. Okay.
Yes.
Now what they are saying here? Using the information in activity 1 above, assume that in the year ending 31st March 2016, the goodwill of Bing is impaired by 20%.
Yeah.
So you know how much is the goodwill?
32,500. So into
20%.
3,250, 6,500.
Correct.
Impairment is 6,500, right?
Yes. Now in this question,
Yeah.
we do have NCI.
Yes, yes. Yes.
What percentage of NCI is that?
So NCI is 12,500.
No, acquisition percentage.
Acquisition percent 80%.
80% for parent.
Yes, 20%
to
per.
NCI.
Correct.
So now your impairment total value is 6,500. On that, how much we should give it to NCI then?
80%. 20%.
Ah.
So 80 and 20, right?
Yes.
So this is 20% goes to NCI.
Hmm.
So that means 650, 1,300.
Hmm.
So that means debit NCI
How much?
1,300.
Okay. Completion.
Debit
Okay.
group return earning.
Very good.
6,500. That means 4,000, 5,200.
Very good.
Then go to goodwill.
Credit.
Credit 6,500.
Correct. Next subtitle. Gain on bargain purchase.
Negative goodwill.
Negative goodwill. We discussed this.
Yes.
You can say that normally there can't be any gain on bargain purchase. කවුරුත් මෝඩ වෙන වෙන්නේ එහෙම දෙන්න. There can't be any gain on bargain purchase. I hope you also, it was also meant to say that negative goodwill. Huh?
Yeah.
However, still the calculation results such a gain on bargain purchase. Then IFRS 3 recommends the following. It requires to reassess the entire calculation, which includes the measurement, fair value, addition, calculator, usage, everything.
It requires to reassess the calculation.
Entire calculation relates to goodwill. This is requires to evaluate any possible errors. ඒක වැරද්දක් වෙන්න පුළුවන්. Could be a mistake or you are playing it.
Correct.
Finish. Second bullet point. Still, any excess remaining should be recognized to profit and loss account immediately. You need any example?
See, any excess remaining
Should be recognized in profit and loss account immediately. Now, the purchase consideration is 100. NCI is 20. Total 120. Normally what we expect is net asset of the subsidiary. Normally expect the answer to be less than this.
Yes.
But in this situation, let's say this is 150.
Yes.
Then
30.
I have 30 minus. This is what we call gain
Negative
on bargain purchase.
purchase.
Or we can also call it negative. In this situation, what are we supposed to do?
Yeah.
First, my friend, you may have done some mistake here or here or here. When I say here, it has breakdowns. Share capital, reserves, and then NCI, how you taken it. Like that, every single, and also purchase consideration, there are different calculations, deferred consideration, blah blah blah. So, you go and reassess every single calculation and see if any possibility of errors. If it is so, you rectify those. If not, still the difference is retaining, then take it to profit and loss account, and they say
Other income.
immediately, yes, other income. Clear? Right. Now, subtitle, fair loss. Fair loss, within bracket you can write IFRS 13. In consolidation, fair value should be used, particularly in the following areas. One by one, right? Purchase consideration. Number 2, non-controlling interest. Number 3, net assets of the subsidiary. See, there is a possible adjustment you may come across after some time. The subsidiaries properties, they will revalue for the purpose of this particular business combination or consolidation, and then they will arrive at a gain. How you incorporate that gain is part of this, and then there is another possible adjustment related to that. They will also talk about remaining life of that property, and they will also talk about the depreciation. And then you may have to, if your balance sheet date is 31st December 2016, and if acquisition date is 1 January 2016, and you have done your consolidation working on 1 January, you have calculated your fair value gain also on 1 January. When you reach into 31st December, then you have to calculate depreciation for that year. When calculating depreciation, also then you need to refer back to IFRS 16 whether any fair value surplus is transferred to retained earning for the purpose of excess depreciation. These things you should keep it in mind. Clear? Fine. So, the definition.
Next subject, no?
Part of the fair, what is fair value? We are going to write that.
A definition.
Yes. The price that would be received. Remember, this definition is going to repeat every single step.
Yes.
Okay?
Price.
The price that would be received to sell an asset. ഇതൊരു ടെംപ്ലേറ്റ് മാതിരി എല്ലാ സാപ്പാട്ട് മുന്നുക്ക് പിന്നുക്ക് you need to know. Receive to sell an asset or pay to transfer a liability.
The price that would
Receive to sell an asset. See, I am selling this asset, so I am giving you. How much you are going to give me? That's the price that I am getting. Or I need to settle some liability for you. So either way, in an orderly transaction, that is very important. In an orderly transaction, meaning on a normal circumstances, between market.
under normal circumstances.
Yes. Yeah. No orderly transaction meaning under normal circumstances between market participants. Market participants at the measurement date. Before the fair value is decided, the value that is arrived between knowledgeable and willing parties in an arm's length transaction. Now they have removed those terms and then they brought this. Now instead of arm's length transaction, now they say orderly transaction. You would normally expect this type of transaction to occur. And market participants. Clear? So that is definition comes from IFRS 30. Now you can say that the measurement of NCI. NCI can be measured NCI can be measured in the following method. First one, fair value. Meaning, how much it will cost. How much it will cost to the acquirer to purchase remaining shares of the subsidiary. Full stop. Next line. This known as the goodwill on this method is known as full goodwill method. And next line, this goodwill contributes contributes a portion attributable to NCI. That's all about full fair value method. Second method, proportionate share method. See, this is fair value number 1. Now you are writing number 2. Proportionate share method. At the time of calculating goodwill, NCI will be taken as a proportionate share of the
proportionate
share of the fair value of the acquiree's identifiable net asset. I'll show you an example, you will understand better. See, my identifiable net assets of the identifiable net asset, that's it. Okay, see this situation. Now my purchase consideration 1,000. Okay, my net asset of the subsidiary 800. Now the parent company acquires the subsidiary 80%. Meaning, how much is the NCI?
20%.
20%. So what we do now, we calculate 20% of this. How much is that? 160. So we take NCI 800 into 20%. So that is 160. So how much you get here?
So 1160.
1160. How much is this?
800.
800. So what is the answer here?
360.
Now my question to you, this goodwill, is it, in arriving this goodwill, is NCI is included or excluded? That's my question to you.
It says included.
I will show you, it is excluded.
Excluded.
How? See, purchase consideration. I am now going to show you calculating goodwill on an old method. Minus net asset 800. NCI 20%. How much is that? 160. How much is this difference?
640.
640. What is the answer?
Same answer. 360.
You remember we talked about impairment.
Yes.
And we said that if the NCI is measured at, you need to answer, right? If the NCI is measured at fair value, then we need to pass the double entry as debit group return earning, debit NCI, and then credit to goodwill. That is when we measure using fair value. Something like this situation here. Whereas if you are measuring using proportionate share of the identifiable net assets of the subsidiary, then this goodwill is purely for the group. Actually, the group goodwill will be approximately. Yeah? This will not be the precise answer. Approximately, brother. Can you find out how much 100% coming?
360.
Divide by 80%.
450.
450. This will be the total goodwill. But this method actually, old IFRS 3. This is IFRS 3 old method. Even actually not before IFRS 3, IAS 27. That time IAS 27 explains about how to now when we do CA, when we do chartered accounting, and when we do the advanced financial reporting from a Sri Lankan point of view, this is how we have calculated goodwill. Now that IFRS 3 came in, and IFRS 3 went on to revise the IFRS 3s in several iterations. Now the final iteration says this is not the correct method of doing it. What you do is you work out the fair value of NCI as well. Understand me? So second method we write it down.
Yes.
So if you want, you can copy this example.
Share it.
I will. Okay. Then fine. Now another fair value of NCI.
The third one, huh?
No. Relate to that topic. I want to give some additional explanation. Now, one we talked about, we arrived the fair value of NCI as a bulk answer. Meaning, without going into the details of it, make it a atadana, finish. Or, we take the fair value of the shares of the subsidiary at the date of acquisition. Both are fair value. Sometimes some questions they will say the NCI, now in the previous example, you remember we reading NCI is measured at 12,500. That is this method.
Yes.
Sometimes they will say the share price of market price of the shares of the subsidiary is $2.75, and then you should know how many shares remaining for NCI. 2,000 shares, 20,000 shares, 10,000, whatever it is. Then what you do? You multiply that by that number. So here bulk example
Correct. It's a fixed term.
12,500. Here 2,000 shares into
market price.
2.75, for example. Total number of shares 10,000, 20% they acquired. So that is this. Clear? So this is what you also need to have an understanding of. Can you try this example now? Right.
Yes, cash.
On 31st December 2018, Penn acquired 4 million of the 5 million $1 ordinary shares of Sylvania.
Correct.
So that means what percentage of the
80.
80%. Paying 10 million in cash. On that day, the fair value of the Sylvania's net assets was 7.5 million. Clear. Calculate the goodwill arising on acquisition. Penn has elected to value the non-controlling interest at acquisition at fair value. The market price of the shares held by the non-controlling interest shareholders immediately before the acquisition is $2. So this is one method. Second method, Penn has elected to value the non-controlling interest at acquisition in its proportionate share of the fair value of the subsidiary's identifiable net assets. Also please remember IFRS 3 disallows this second method. But the
Disallow?
The second method.
Second.
The proportionate share method is no more.
Not
Right? So can you try, or you want me to try, or how?
So in short,
See, I have purchase consideration. How much?
4 million. 4 million shares into.
No. What is the cost of the purchase?
Yes. So 4 million shares into 10 million. So
Yeah.
So he's paying 10 million in cash.
Exactly. That's what I wanted to know. 10 million. Okay? Then we wanted to work out the NCI. Now, what is the net asset? Subsidiary's net asset how much?
7.5.
7,500. The first method of valuing NCI is what?
On the acquisition percentage, acquired percentage.
No.
20%.
Penn has elected to value the non-controlling interest at acquisition at fair value.
Yes.
Correct? The market price of the shares held by the non-controlling shareholders immediately before the acquisition was 2.
Two.
Now we need to understand how many shares.
So 1 million shares into 2.
What do you mean?
Remaining is 1 million.
1 million shares.
Into 2. That is the fair value of NCI.
Yes. So 2 million. So 12 million. So the goodwill is
12 million. Net asset is 7.5, right?
yeah. එතකොට මල්ලි 4.5.
Yes.
The goodwill is 4,500. Second method. Purchase consideration no change. That is 10 million. NCI we need to decide. Then net asset 7,500, right?
Yes.
And what is the basis of goodwill? NCI they say Penn has elected to value the non-controlling interest at acquisition at its proportionate share of the fair value of the subsidiary side.
So this is the one 20%.
Correct. 20% of what?
Of the net assets.
Yeah. So how much?
So 150. So 1.5 million.
1,500. So 11,500 minus 7,500. So that means 4,000.
So 1.5 means 1,000.
So this is the clear? See, they say, I will share this to you. ACCA examining team has stated that they will only test partial goodwill as a comparison to the full goodwill. They are not going to ask you a detailed question on partial goodwill. Approach we have used so far. Now, subtitle: Fair value of identifiable assets. Acquired and liabilities assumed.
So that is a heading, fair
Yeah.
value of identifiable assets.
Assets acquired. No, the one the continuation. Huh?
Yeah.
Acquired and liabilities assumed. IFRS 3 requires the subsidiaries assets and liabilities to be stated at its fair value. On the date of acquisition. So normally what you need to do is, let's say you are taking this furniture, this table. Your job is to, if it is you are doing a measurement of this table for the purpose of consolidation, then first of all you need to find out how much is the fair value in the market. If the market is 100, carrying value is 80, you should take 100. Suppose if the market is 50, you should also take 50. Suppose if the market is 100 and the carrying value also 100, then no problem. What they are saying is, as long as the fair value is different to the carrying amount, the calculation should always include the fair value. Clear? So that's what we are meaning to say, the fair value. Next line, any difference between fair values and carrying amount, should be considered as a consolidation adjustment. Consolidation adjustment. As a consolidation adjustment. So when I say consolidation adjustment, you also need to remember we do consolidation on a temporary basis. This is not going to impact our individual financial statement. That also has to be remembered. Subtitle: Restructuring and future operating losses. Restructuring and future operating losses. The acquirer should not recognize liabilities for future losses. දැන් එයා ඇවිල්ලා කියන්න බෑ මේ මහත්තයෝ මේ ලබන අවුරුද්දේ ලොස් එකක් තියෙනවා ඒක දැන් මම මෙතන recognize කරනවා. No, you can't do that. So it's opposite of what we talked about that one man story. Clear? So, or other cost expected to be incurred as a result of the business combination.
Expected to be incurred
As a result of the business combination. Next line you can say IFRS 3 explains that a plan restructure a subsidiary following on acquisition is not a present obligation. Is not a present obligation of the acquiree at the acquisition date. Full stop. Now, when to talk about now later when studying IAS 37, we will discuss about the liabilities. To talk about liability, present obligation is very important. In this case, you say that okay, now this year we are acquiring, next year we will do some restructuring, we will send 20 people home and we will rebuild this building, blah blah blah. You are making some plan, so you are planning to do some restructure. That restructure is not a current obligation for you. It's not under any obligation at this point of time. Accordingly, you cannot recognize this as liability. Neither it is even not a contingent liability. One argument may develop under IFRS 3, contingent liabilities are you need to recognize. So that's what they are precisely saying. This is not even contingent liability. Clear? Okay. Next subtitle, I will share this. Assets and liabilities. I will just share now. Assets and liabilities only recognized, you don't need to write. I have sent it to you. Only recognized on consolidation. Internally generated intangible asset recognized as non-current asset as acquiring company is giving valuable consideration for these assets. You remember when we talk about IAS 38, we said that internally generated goodwill, intangible asset we will not going to recognize. But here you will recognize if you separately acquiring apart from goodwill. Your acquisition, that list of assets that you are acquiring, this is also part of it.
Yes.
Not arising as a result of goodwill. And they say that they are making a valuable consideration for these assets. When you are arriving the negotiation, you adding some extra value for this also. Secondly, contingent liabilities recognized, providing it is a present obligation and its fair value can be measured reliably. IAS 37 rules do not apply. That has to be clear. The next is measurement period. See, if the initial accounting period for a business combination is incomplete by the reporting period in which the combination occurs, provisional figures for the consideration transferred, assets acquired and liabilities assumed are used. So, initial accounting period for a business combination is incomplete by the end of the reporting period. It's not took place on the reporting period. So, in order to prepare the financial statement or in order to complete the goodwill business combination calculations, what you do is you take the provisional figures for consideration transferred, assets acquired and liabilities assumed. Adjustment to the provisional figures may be made up to the point the acquirer receives all the necessary information. What they are saying is, I will explain you. (31st December 2022). Now you are planning to acquire the business. You are acquiring the business on this next issue. But related information with regard to the subsidiary, you receive only on 1 April 23. You need to complete your goodwill. Your business combination calculations on this date based on the provisional numbers.
Yes.
Then when you reach to here, you will then have the actual data. You then have to restate the calculation. However, but they also say something. May be made up to the point of the acquirer receives all the necessary information or learns that it is not obtainable. Either. Sometimes if you feel that you cannot take it with a corresponding adjustment to goodwill. But the measurement period cannot exceed 1 year from the acquisition date. It has to happen less than a year. Clear? This is the diagram that they are explaining about that. Acquisition date 1 May 2017. Year end is 31st December 2017. End of the measurement period should be not later than 30th April. Within this period, you should complete your business combination. Only correction of error permitted. After the 30th April 2000, after 1 year, you only can do some correction to 30th April. With this, we will stop for the day, and then we will meet tomorrow night.
So tomorrow night is our last class.
Next Friday.
ಇಲ್ಲ ನಾನು ಟ್ಯೂಸ್ಡೇ போயிடுவோம் ಇಲ್ಲ
நீங்க டியூஸ்டே போலாம் படிக்கிறீங்க கேலண்டர் பார்த்தேன் நாங்கள் இன்றைக்கு வந்து 23
இன்னைக்கு 23
30 தான் அடுத்த வெள்ளிக்கிழமை. அப்போ அந்த டேட்டுக்கு நீங்கள் இருக்க மாட்டீங்க. நீங்கள் 27 போகலாம்.
கரெக்ட்.
சரி, அப்போ நாளைக்கு அந்த 24 24 சரி, நாளைக்கு தான் எங்களோட லாஸ்ட் கிளாஸ். சரியா? சரி, பார்த்தேன்.